Well, the Fed may try to use the general interpretation of that data as an excuse to pause its rate hiking. It's probably been looking for an excuse to do that for a while. And so I think it may try to hang its hat on the CPI numbers that are not quite as bad as they were. But if you look at the numbers, we're still looking at 5-6% inflation as measured by the CPI, which I think understates by design just how big the price increases actually are. So if the CPI says 5, it's more likely 10. So we have pretty high inflation, even if it's not as high as it was last year or 2021. But also, I think probably more significantly is the improvement that we've seen in the inflation numbers where they've come down a bit. I think that's transitory. I think that by the end of this year, or certainly by next year, we're going to see the numbers getting bigger again, and that ultimately we're going to eclipse the peak of year-over-year CPI that we've already seen. So inflation is not conquered, not even close. I think this cycle is just getting started, and we're going to see new highs in the year-over-year inflation rates. The inflation that we're currently dealing with, the Fed has been creating it for more than a decade. You really have to go back to quantitative easing 1 in 2008, 2009. That's where the Fed really started the money printing in earnest. And we're dealing with the delayed consequences of that now. I mean, inflation by definition is an expansion of the money supply. And so we dramatically expanded the money supply. The consequence of that is prices have to now adjust to a higher equilibrium, given all the money that's now available to buy stuff. And so we've just started that adjustment process. And I think prices have a long way to go on the upside just to catch up to the inflation that's already been created. But I think paradoxically, one of the reasons that I think the CPI numbers are going to spike to new highs soon is all of this optimism that inflation is cooling down has caused the dollar to drop. And I think the dollar will continue to fall. It's now down about 15% from its high last year, but I think it's on the precipice of another major decline. I wouldn't be surprised to see another 15 to 20% drop in the dollar between now and the end of the year. And I think that dollar weakness, which is a consequence of people starting to price out some of the rate hikes that they had priced in fact, starting to price in the next round of rate cuts. Also, the Fed has quietly returned to quantitative easing while pretending they're still doing quantitative tightening. So all this is dollar negative. And what's going to happen as the dollar weakens, that's going to push up commodity prices across the board, oil in particular, but lots of other commodities are now going to be breaking out to new highs. And it was the pullback in those commodities that helped bring down the headline inflation numbers. But I think when they start soaring to new highs on the back of a weak dollar, that's going to help drive those CPI numbers to make new highs. I mean, thanks to government guarantees and government insured deposits and the moral hazard that created, and the fact that for better than a decade, banks were encouraged by regulators to load up on treasuries and mortgage-backed securities, which they now own. And now that the Fed has finally raised rates, this portfolio is underwater. So banks are sitting on huge losses that they're not really marking to market because they're pretending they're going to hold these securities to maturity. But they really don't have the ability to do that because the customers are going to want their money back because the money is losing value to inflation. And they want to take that money and do something else with it. I mean, some people might want to just buy treasuries and loan it to the government at 4 or 5% rather than leave it in the bank at close to 0%. So the banks are going to have to sell these securities, and they have huge losses, which they can't absorb. And so they're going to rely on the Fed as a crutch. They're going to try to deposit these underwater securities for par at the Federal Reserve and then use that money to repay depositors. But, the banking system is a disaster. And, your point about are bank deposits safe? No, they're not safe at all. They're in, grave danger. There are two possibilities for your bank account. Neither of them is good. One is that your bank fails and you lose your money, right, or a portion of the money that you have on deposit. Alternatively, your bank doesn't fail because the government has bailed it out. And the only way that they could bail it out is if the Fed prints enough money to cover the cost, in which case you don't lose your money. It's still there in the bank, but it just loses a lot of its value, maybe most of its value. So yes, you can go withdraw it, but then take it to the grocery store. You're not going to be able to put much in your cart because prices are going to go up dramatically as a reflection of the loss of value of the dollar, because the Fed has to print so money to bail out the banks. We've been kicking the can down the road on this for many, many years. So it's long overdue. But, there's an old expression, how did you go broke? Well, slowly at first, and then all of a sudden. And I think that describes what's been going on with the United States. And I think that when the dollar crashes, it's going to happen abruptly. And the dollar's reserve status is going to be lost before anybody realizes that it's happened. And I think that the writing is there on the wall for anybody who wants to take the time to read it. If you look at some of the events that have taken place ever since we were foolish enough to weaponize the dollar and apply sanctions onto Putin, I think that really highlighted the need, a political need, for the world to move away from the dollar. I think they already had an economic incentive to do so, but then we gave them a powerful political incentive to accelerate the process to de-dollarize, and that is exactly what's happening. And most people don't have a clue to the degree to which the United States depends on that dollar reserve status, because our whole economy is built around a service sector. But without imports, there's nothing to service. I mean, we're just a gigantic logistics center where we distribute merchandise that we import and then distribute it to the population. But if we can't import all the goods, well, then there's nothing left to distribute. I mean, the whole thing comes collapsing down. And how do we pay for $1 trillion a year worth of imports with our dollars? That's our trade deficit. It's $1 trillion a year in goods. And we pay for it just by printing money. But the money doesn't cost anything to print. It's free. But all those goods require the expenditure of significant resources. Land, labor, capital goes into the production of these goods. And we basically get them for nothing off of the reserve status of the dollar. And the foreigners who are selling us all this stuff, they just take our paper and they buy treasuries or they buy mortgage-backed securities. But when that stops and the dollar crashes, Americans are going to be too broke to afford to import stuff. And we don't have the capacity to produce what we'll no longer be able to afford to import.